Welcome to weekly view on markets. Last week, I had discussed that market will continue its positive momentum. So we have seen this week that market has gone up from Monday to Thursday, and we have seen a profit booking on Friday with more than about 1% in Nifty. For the week, Nifty index has posted a gain of 0.34% and closed at 17,758. Mid cap index closed with a gain of 0.64%. Small cap index posted a gain of 0.38%. Bank Nifty was dragging the market. Bank Nifty closed in the red with a loss of 0.14% for this week. India VIX spiked up mainly because of Friday movement in the market. It is at 18.28. Volatility has spiked up almost by more than 5% for this week. Now let us look at Nifty chart. This is daily chart of Nifty index. We can see that the chart is in an uptrend, making higher tops and higher bottoms. And it has gone up on Monday to Thursday, and Friday a big red candle has appeared on the chart. And Monday the market has was down by 1.1%. But should we get worried about this? This is just a profit booking based on weak global cues on Friday. Let us look at weekly chart of Nifty. Things look much better on weekly chart. This is a weekly chart of Nifty. I have drawn this flag last week and retained the same. Now we can see that this week Nifty has formed a small candle which is above the upper cloth line, that is the support line of this weekly chart. So there is no damage to the chart structure because of Friday move. So the chart structure suggests that Nifty is going to go up in coming week and likely to test all-time highs. The Nifty all-time high is at 18,600. So Nifty is likely to test these all-time highs in coming weeks. Let us again go back to daily chart to understand the support and resistance. Nifty has immediate support at around 17,600 levels. So till Nifty remains about 17,600, it is a buy on dip market for traders. And where is the resistance? The immediate resistance is 18,000. It is a major resistance, a psychological level. So if Nifty crosses this 18,000, then Nifty is headed for the all-time high of 18,600. So the chart structure indicates that Nifty is likely to test the all-time highs in coming weeks. The market is supported by mid cap and small cap sector as well. Let us look at chart of Nifty mid cap. This is daily chart of Nifty Wiki. Let us go to the weekly chart. The weekly chart of Nifty Midcap Index has formed a downward sloping channel, and last week it has crossed this downward sloping channel, that is the upper cloth line, and this week it has formed a small candle above this. So the mid cap chart structure still indicates higher levels for Nifty mid cap index. Similar is the small cap index. Let us look at small cap index chart. The small cap index chart also is in a up, move, and this up move is likely to continue. The overall markets show positive momentum, and there could be a correction or profit booking of 1 or 2 days, but it is not a cause for worry. The overall direction of the market, the trend is up, and markets are likely to test higher levels. Now let us look at India VIX. India VIX is the volatility index. So India VIX ended this week at 18.28 with a gain of around 3.85%. So the India VIX index is at elevated level. Historically, around 14 to 15 is the normal level. Still, it is at a higher level. So what it indicates is that market participants are still skeptic about the uptrend. They are not overly confident, which is good for the markets. Markets generally tops out and gives a big correction when everybody is overconfident in the market and overly bullish. So India VIX indicates that that kind of scenario is not there at present. So the market's uptrend is likely to continue. These are the technical indicators. Now let us talk about different sectors, how the sectors have performed during this week. As you can see, information technology, FMCG, realty sector, metals, infrastructure sector, consumption durables, that is discretionary consumption, then energy. So these were the sectors which gained from zero point 0.5 to 1.5% in that. There was no major movement, it was a kind of consolidation. And which were the sectors dragging the market? The market was dragged by banks. The bank nifty was slightly down. Private banks were also down. PSU banks were down. Then pharma sector was down. Healthcare sector was down. Manufacturing sectors, but they were not down too much. 0.5 to 1%. Overall, we can see that all the sectors and large cap, mid cap, and small cap indices all consolidated during this week. There was no major movement. Of course, there were intraday volatility in the market. That is why in India VIX is at higher levels. Now let us talk about some of the fundamentals about the market. So if we look at DII and FII activity. The FIIs have started buying, whereas DIIs are selling in the market. The roles have got reversed, are selling. They are selling mainly due to the redemption pressure in mutual funds by retail investors. Why it is happening like this? The retail investors are the weak hands in the markets. So it is a market rule that whenever a big bull run is expected, the retail people get out of the market. They will not get the benefit of the big bull run because of their psychological thinking about the market. The SIP investors and mutual fund investors have seen last 6 months to 1 year their portfolios, their SIPs were all in the red. Now, last 1.5 month, market has picked up at Nifty 15,100 level to now Nifty has come to 17,800 level. So those mutual fund portfolios and investments have recouped their losses. Now the retail investors are worried that there may be another correction and it might go into loss. So they want to take out capital out of the market. And this is the reason that we are seeing DII selling. If we go back to 2020 during COVID crash, there was a big crash in the market, and after the crash, there was even bigger bull market. So if we go back and check FII and DII activity that during that bull phase, for several months, FIIs were buying, but DIIs were selling due to the redemption pressure in mutual funds. The same phenomenon is being repeated again. So the weak hands are getting out of the market, which indicates that the bull run is not going to end very soon. The bull run is likely to continue. This is a good indicator of the uptrend in the market. Next, this week, the WPI figures, wholesale inflation figures have come. These numbers have been coming down for last 3 months. I had been telling that inflation has peaked out. In the month of May, WPI number was 16.63. It was 15.18 in the month of June, and for July it has come at 13.93. So inflation has peaked out in India, and it is likely to moderate in coming months, which is good for the markets. But having said this, the global inflation risk for the market still remains. The UK inflation figures have come at a 40-year high. It is more than 10%. Last week, these figures were announced. So the global inflationary pressure still exists. This is due to the food inflation and the cost of energy, oil and gas prices due to Russia-Ukraine crisis. There is some good news from Russia-Ukraine front. Russia and Ukraine, they have entered into an agreement. Russia is starting or already started. Some shipments have started. They are sending food shipments from Ukraine ports. The few shipments have started in this week. The food supply from Ukraine to global market will have a good impact on the global food inflation. So this is good for the markets. Last 2 weeks, oil prices have come down and they are below $97. So I had told in the earlier weeks that if oil prices come down below $100 per barrel, we will see a rally in the markets. And this has happened, and we have seen the market going up in last few weeks. There is another good development which I view as a good development for the markets is on the IEX. IEX is the Indian Energy Exchange, energy trading platform. The IEX has banned some of the discoms. Discoms are electricity distribution companies. So some of the discom companies have been banned on IEX last week because they had huge outstanding dues which they were not making payments. So this is a bold step from IEX, and this will enforce some kind of professionalism and discipline among the distribution companies. Most of the distribution companies are perennially in loss. So some fiscal discipline and professionalism is required. So this move I view it as a good move for long term for IEX and for the markets. During this quarter one results, the management commentary of various companies have been very encouraging. Managements of various businesses are hopeful about good demand in coming quarters for goods and services, and also there is a credit growth for the banks, and they are expecting, with the inflation in India stabilizing and likely to moderate in the coming months, the corporate earnings are likely to pick up. So this commentary by managements of the companies is a good indicator, and as we know, markets tries to price in future earnings of the companies. So this is one good indicator which suggests that the present uptrend in the market is likely to continue. So this is all for this week. We'll meet again next week. Thank you.